Good. Well, welcome everyone to the panel on housing finance reform. We have a distinguished group of panelists. So I'm going to do a quick introduction, and then we'll get going. And I want to listen to them and learn from them. So I'm Phil Swagel. I'm a fellow with the Milken Institute. We have an office in Washington, D.C. that does healthcare research and financial markets research, and so I do the financial markets side out in Washington, D.C. with the Institute, and I'm also a professor at the University of Maryland School of Public Policy. So that's my self-introduction. Let me start over here with the first of our distinguished panelists, is Gene Sperling, who's the director of the National Economic Council, the NEC, for both President Obama most recently and President Clinton before him, and worked extensively on housing finance reform and basically every other economic issue. Number two, going from left to right, is Josh Rosner, who's a managing director at Graham Fisher, which is an independent research consultancy, and he's written extensively on both the financial crisis and on housing. He has a book with Gretchen Morgenstern from the New York Times on Fannie and Freddie, but if you go back before the book and look at some of the stuff he's written, you'll see is pretty prescient. It's pretty, you look 2001 and on, and he's one of the guys who called it right. So he has a lot to say, I think is fair. Continue is Drew Newton, who's a managing director at Citi. He works on distressed debt and distressed assets, and was previously in a similar position at Merrill Lynch. Let's see. Jim Lockhart is now a vice chairman at W.L. Ross. He's actually the man who put Fannie and Freddie into conservatorship. So he was, he didn't cause it, but he put him there. So Jim was the director of the FHFA, the regulator for Fannie and Freddie, and before that of the predecessor of OFAO, and has a long and distinguished career in public service and also in markets. And then last is Don Layton, who also has both public service now as the CEO of Freddie Mac, which is, of course, an interesting position because it's very much a public service position, but also a CEO of a private company, and has a long and distinguished career in markets before that, including 2.5 decades at JP Morgan, and then the CEO of E-Trade during the financial crisis and helping the firm get through. So why don't I move on quickly, and I'm going to ask some questions. And I'm going to ask, I'll start with Gene and just go in order I have, ask some questions, and then ask each of our panelists to comment on each other. Okay, so my observation is that there's 5 bills in the, between the House and the Senate on housing finance reform. There's a remarkable amount of interest, and what's especially remarkable in our political, in our divided political system is how much bipartisan support there is for reform. And obviously, it's not universal. There's lots of disagreement, but there's a lot of interest. And then you look at the specifics of say, Corker-Warner or Crapo-Johnson, and those 2 bills have bipartisan support. So, Gene, maybe you should start by telling us how did this come about, and really why does it matter, and what does it mean?
Well, on both the process and substance of how it came about, I think that we were committed to coming forward with maybe not legislative language, but pretty specific reform principles in 2013. I think that as that became more well-known in the community, I think there was a key moment when Senator Corker called me and said, I have a feeling that we're not that far apart. I think that Senator Warner and I can pull together a group of 8 or 10. And then just really reflected the political reality of Washington, that like immigration reform, if the president went first, it might politicize the situation, force more Republicans to go to the right of him. So very much like immigration reform, the request was, let us give this bipartisan effort a try. Help us behind the scenes, give technical advice, give a sense of what the bills is ultimately going to be satisfactory, what kind of bills ultimately going to be satisfactory to the president. And, our mandate's to get things done. And so in Senate and immigration reform, that had worked, us stepping back, working behind the scenes. So we met with Corker and Warner, and, first thing you had to find out is, was there really a common framework. You knew it's going to take months to work out all the details. And I think what we found was that there was a commitment, there was a common sense of what was wrong and what was unsustainable. That you could not continue to have an implicit subsidy for a duopoly, one. Two, that duopoly would control the basic infrastructure of housing. You know, we all love the internet. Isn't it beautiful? Anybody can, enter and you can have all sorts of competition. Well, housing finance is the opposite. It's the complete opposite. The two major players control this platform, and this platform is wonderful, but it's controlled by the two. That increases the degree that they are too big to fail. So you needed to do something to end the implicit subsidy. We agreed that we had to have a common infrastructure and reform that anyone could use, and that you could not continue to have this very weak regulator and no capital buffer. No capital buffer at all. The taxpayer as the only capital buffer. And I think that we realized that if we didn't do that, we would be letting too big to fail in housing continue, which is exactly the case. And I will say, my old boss, Bill Clinton, used to like to say, the best time to fix a leaky roof is when the sun is shining. If you don't fix this now, what you're basically saying is, you have a new saying. It's the worst thing to do is not to fix the house when the sun's shining, then let it rain horribly, ruin all your furniture, and then decide that when the sun shines again, you don't really need to do anything. That is the argument pretty much for the status quo. But what I want to say is that we also, and this was the key part, we also realized that we had to protect what was good. That we did have a system where we were able to have a broad and deep securitization market with a TBA market that worked, and that part of that required there to be an ability for people who wanted to take long-term interest risk but not credit risk to still invest. And I think that was a practical recognition by the Republicans in the Corker-Warner group that meant that if you could structure it with enough private capital first, enough first loss provisions. And remember what you have in Corker-Warner, and really Corker-Warner and Crapo-Johnson are really, Crapo-Johnson is an outgrowth of Corker-Warner. So they're really, that is kind of the new bipartisan bill. And I think what they recognized was that if you had this kind of ultimate backstop that, based in two ways. One, you have a strong regulator in FMIC. Number two, you have first loss provisions in capital. But number three, the idea that you would have a backstop, but the backstop would be explicit. It would be actuarially determined. And that, so really it's like a double backstop, because now you have 10% or 5%, whatever you're arguing for, first loss provision, which should be enough if you look over the last 50, 100 years. Then in addition, people have to pay into a new fee, like we have the DIF fee for the FDIC, a new fee that will eventually be 2.5% ratio. So this was strong protection. With that, we felt we could go forward. Then we had to give them the hard news, which is we can't do this. We can't do the things you want unless you have some commitment on the affordability side. And I think when they said they were willing to have an affordability fee, we knew we'd argue over the details, but I think we had a basic structure. And then I think the key was that Corker and Warner did an excellent job. They deserve huge credit for getting this going. But that wasn't going to lead to a bill unless the leadership, Johnson and Crapo, then built on it. And so we then switched and started working behind the scenes with them as loyally and as faithfully as we did with Corker Warner, so that now I think you really have a situation where there was a bipartisan bill that started, and the four of them really understand that they've all played an important leadership role.
Okay, so let me ask you a follow-up. So I think it's fair to say there's opposition from both left and right, but it seems like the overarching concern, if I read it correctly, on the left is that really the government controls housing, and why should we want, again, speaking from the left, a smaller government role in housing? Is that even desirable? And so there's a sense in which some of the attractions of the approach for the president might not be attractive to people, sort of further on one side. And how would you address that? And so it's almost like, what's the progressive case for reform?
I have to say, what I find, and I think this is a little bit of a a little frustrating. I'm not frustrated by the people who are raising legitimate issues. There's legitimate issues about vertical integration. There's legitimate issues about capital market execution versus the guarantor model. There are legitimate issues about whether you need 5% or 7% or 10% and under what circumstances and what counts. Those are all legitimate issues. And for the people who are raising those and trying to get in, whether you can have alternatives to a 5% down payment, those are all legitimate issues. The only thing that discourages me is when people just decide, just for no, I think, good reason that they can truly articulate, that somehow they'd rather live with the status quo. Mm-hmm. Now, from a progressive point of view, I don't think the status quo is working. First of all, if you believe in an active role for the government, you should care about trust in government. What would be worse for trust in government for us to all do nothing? People think everything's so great now. Let's remember, we were this far from going over the fiscal cliff in 2012. This far. Had we gone over the fiscal cliff, housing could have turned around like that, and you could have been paying, a taxpayer could have been paying again. So, this is a real threat. So if you care about government working well and trust in government, you should want to fix this. Secondly, the access fee would raise almost $5 billion a year. People think that the new FHFA director, Mel Watt, could do something. I don't think he has any means of getting more than $500 million, 1/10 the amount. So progressives who just want to leave things as they are leaving, I think, $50 billion on the table that could be helping first-time homeowners, low-income families. Third, it's an interesting thing. The system is not working well right now. As often happens in crisis, it swings too far the other way. FICO scores are way too high. The average FICO score, I think, in Fannie and Freddie now is 760. It's about 700 for FHA. That's too high. That is too high. That means lots of people are being shut out, and lots of people of color are being shut out, and the market's not been good for African Americans. So there's a sense that is not working. We all agree. But then I think a sense of, well, perhaps we can just live with the status quo. And I guess I think that the progressive community, their different groups have different views, and I guess I would just say to them that you just can't have this bias for the status quo. When you have a chance to do the right thing, to move the ball forward, get in there and work on it, try to improve it. But I think it's a mistake for progressives to say that. I think that the status quo is better. I don't think it will be better. They'll never get $50 billion over the next 10 years. And on the conservative side, those who want the status quo, you take the risk that if you do nothing, you've actually institutionalized a complete government role. And the absence of the innovation and competition that I think, if structured well, will be good for average homeowners, but I think also could create competition and certainty that would be good for lower income Americans as well, if done right.
Okay, no, very good. Okay, let me open it up to the other panelists. Maybe I'll just start with Josh and go this way, and next question I'll go in the other direction. Just any quick thoughts on Gene's answers there?
Yeah, well, first of all, I think it's important to really start with the question of what went wrong, why did the enterprises fail, and are we solving for that problem? And I would argue, and I will explain why, the answer is no. More than that, the notion that bringing more players into the secondary mortgage market, thereby increasing competition, is going to be pro-markets, I think is demonstrably wrong. If you look at Fannie and Freddie, what you ultimately saw was as more and more of the volume went to Fannie, Freddie's execution ended up worse and worse in the markets. They traded wider and wider and wider, which created major risk to Freddie. And if you open it up to more players, including in the aggregator model in Crapo-Johnson, really what you're going to do is move towards increased concentration. Now, think about it just in terms of the baby bells, as we saw. Specifically, we've got a small bank aggregator, and the securities that come out of the platform from the small bank aggregator will have neither the diversification nor the volume that those coming from the large bank aggregators will. And therefore, over time, they are going to see, like Freddie did, but on a larger scale, the economics move away from them in terms of execution. And ultimately, they'll be relegated to becoming either holding mortgages on their books or, on the other side, forced to become third-party originators for the big banks selling into their aggregators.
Okay. So let me and we're going to come back to this to some of the potential criticisms. So I'm going to hold the thought, and we're going to keep coming back. Drew, do you want to? And again, we're
well,
quick.
I guess just one quick point that I would make, and I just sort of asked the question, and it's probably not a popular thing to say right now, but what exactly would it mean for the system to not keep the status quo? And I think it's pretty heroic, obviously, on a bipartisan standpoint, what the White House has done with the Senate Republicans and Democrats. But I guess what sometimes confuses me a little bit is, why not enhance the status quo? Why not build capital? Why not turn it into a tightly regulated utility with no retained books and explicit guarantee and explicit rules and regulations around rep and warranty? It just seems like, we've gone a long way to sort of fixing the problem, and I think it's massively commendable. I just wonder at times if, we've maybe overshot even further what we need to do, given that the system for a long time did work. It held up obviously massively better than any other part of the housing system. So I just wonder if sometimes we may be overshooting the mark a little bit, and there aren't a lot to do within the current framework that's not the status quo. Okay, so I think of that as Plan B or maybe Plan C. We'll come back to that, Jim. And
well, my view is that this has lasted a lot longer than we expected when we put them into conservatorship, and certainly we need to get the government out of housing the massive way they are today. I think Johnson-Crapo has some flaws, but it's a step in the right direction. And I think, hopefully Congress over the next, and probably will take 2, 3, maybe even 4 years, get their act together and create something that works, that is not dominated by the government. I mean, we're investors in banks in Europe, and the governments are not in the housing market in Europe, and yet here in the U.S. they're 80%.
Yeah, there's an irony. Okay, now Don, I know you have restrictions about you can't talk about policy, but I'll still turn to you in case you have thoughts.
Well, the best part of this is I feel like the patient in the operating room with the doctors arguing. Doesn't make me feel great. I'll just want to highlight one point which Gene made. The mortgage business is ridiculously complicated, so it's wonderful to talk at a policy level. The devil is totally in the details, and it's more than a few months of trying to get those details right. We participate in the whole legislative process as technical experts, and it's ongoing, and I don't envy everyone trying to figure out how to put enough detail in the bill to get what you want, but leave enough discretion to the FMIC to make things work as you hope. And that's a real struggle.
Okay, no, very good. All right, and we're going to come back again. We're going to keep coming back and forth. So let me ask Jim next. So obviously you were, as I said, you were the regulator. You're the person who put the firms into conservatorship. And then, of course, you continued as a non-political position. And so you had really a bird's eye view of both the intervention in the fall and then the suite of housing policies, including HARP, which you of course, had an instrumental role in developing. And so let me ask you to talk about what you learned, and then what are the implications of the experience that you had for housing finance reform?
Happy to. Could I get a slide?
And I know there's a slide. You have a slide here.
Slide 7, I think it is. Basically, as you look at the future of Fannie and Freddie, you got to look at what went wrong and get the lessons learned from that. Certainly, there was a housing bubble that was a massive bubble, and that was fueled by everybody, really, buyers, investors, originators, Wall Street, regulators, even us regulators, and Fannie and Freddie. And part of the problem was that there was really no clear demarcation of the private and public sector, and any legislation is going to have to do that in my mind. Certainly there was no debt discipline. The rating agencies rated them AAA just because they had large market share, not because they had any capital. And there was a lot of push from the directors and the shareholders for growth and market share. Obviously, 1% capital was much too thin, and especially as most of it was a deferred tax asset that disappeared as soon as we put them in the conservatorship. The affordable housing goals set by HUD were much too high. In fact, they were almost set at a penal rate because some people didn't like Fannie and Freddie in those days. The portfolios were much too large and complex to manage, and in fact, why they had those portfolios, we actually froze them, but by that time they were so large that most of the management was spent on the portfolios and didn't worry about credit risk. And by design, AFEO, the agency that I took over in '06, had a very weak regulatory structure. The new legislation, which came, what, 40 days before we put him into conservatorship, was stronger, but still needs some work. But there's one success story that you should remember about this whole thing, and that's that the multifamily world worked. And it worked very successfully. And why? Because there was skin in the game. There was detailed underwriting by Freddie. And so there are examples of how you can make this work. If you go to the next slide, the U.S. housing market is really much too dominated by the government at this point. At one point, it was 90% by the gorillas, Fannie and Freddie. You're the smaller gorilla, I guess. Yeah. But again, you can see it's 80% market share between Fannie, Freddie, and the FHA, VA. We're starting to see in the multifamily side, actually, the private sector come back, and I think that's a really good situation at this point. And that we're seeing, actually, the commercial mortgage-backed security market come back. You know, unfortunately, in the single family, we're just not seeing much activity in the RMBS side.
Okay. Okay. Let me ask you about some of the key tensions in Crapo-Johnson or an approach like it. The capital is one key tension, and Josh and Jean each alluded to that. Another one is really the role of the regulator in the new system, and obviously you have particular expertise in that. And the regulator in this new system will be required to have high standards for origination, for capital, for the behavior of the firms, and then also to respond when the cycle turns, right? Not to go all the way to be a macro regulator like the Fed, but there will be an element of the new regulator taking away some of the punch bowl, right, when the party gets started, much like the Fed is expected to do. So can you talk a little bit about that, about the stresses on the regulator and how you would expect them to respond, including as the business cycle turns?
Certainly. Maybe we've had enough of gorillas. Can we go on to the next slide?
So, and I got the slides on paper, so I didn't even know about the animation, which is awesome. So.
Can we go to the next slide, please? Yeah, I mean, the regulator is in a very tough position. All the financial services regulators were, you know, we were frankly pretty slow to react in this marketplace. There was, you know, for instance, the bank regulators worked for well over a year, maybe almost 2 years, on non-traditional mortgages and subprime mortgages before they got it implemented. And the banks were telling me even when they got it implemented, they were not going to follow it. And you know, so we actually made Fannie and Freddie do it first, and it helped a little bit. But the new legislation has some form of a catastrophic reinsurer in one form or another, in the Senate bill. And I think it's probably going to be necessary, especially if one wants to keep a 30-year fixed rate, fully prepayable mortgage. That's impossible for a bank to keep on their balance sheet unless they're crazy. And so, you know, we will need some form of insurance. But the regulator itself, it's a tough role. And, you know, what the key aspect of any reform has to be build in countercyclicality. The mortgage market is extremely cyclical, and every policy we had and still have are pro-cyclical. And so we need to figure out mechanisms, and frankly, I'm not sure Johnson-Crapo has enough of that in it at the moment. And one of the things that I've said, and this is difficult, but maybe some of that countercyclicality should be hardwired in so that the regulator can't even change. I think even in Johnson-Crapo, there's too much flexibility for the regulator. And frankly, regulators are subject to political pressure, and you know, that can be a problem. It is very hard to take away the punch bowl. You can see what happened. We had a crash of housing prices, and what we need to do is to figure out some way when housing prices get well above the trend line or get well above rents, that the punch bowl is taken away. And if you have a catastrophic reinsurer, one way to do that is to raise premiums or cut back in the amount of reinsurance given. My view is it probably should only be 30% of the market, not, you know, the 80% today or 70%.
Okay. Okay. And so I was at Treasury during the crisis, and you know, one of the experiences we had was the private guarantors. Right. This is the Crapo-Johnson system relies first on private guarantors, and right, of bond and mortgage insurers, only one of them actually survived really at full force, and it was AG,
Exactly.
right, which is your firms. So there's a lot of stress there, and the regulator trying to respond. So let me go to the panelists. Maybe I'll go start with Josh again. So any thoughts, any responses, or even questions for Jim, and we'll just go down the line, and I'll keep asking.
So one of the problems with the procyclicality is tied directly to the mission of the regulator. And whether it was OFEO or whether it was FHFA, you had this tension that existed between mission and safety and soundness. And when times are good, the pressure, especially from Congress, is to err on the side of mission. Do more, do more, do more, and pay less attention to safety and soundness, regardless of what the safety and soundness element of the regulatory community believes. So Crapo-Johnson actually adds another level of complexity. So it would be a regulator not only for safety and soundness, not only for mission, which, by the way, it essentially says mission is primary over safety and soundness in the bill. Third, it also creates a consumer protection piece. So the coordination that would have to happen between the various regulators as a result of this bill is unprecedented. Beyond that, I agree that the private market is too small, the enterprises are too large as a percentage of the market. As someone who warned back in '06 that we were going to have a credit market meltdown driven by the PLS market, it's important to remember that part of the reason for that was complexity. We had 300 different pooling and servicing agreements in place. We had different reps and warrants in place. As early payment defaults started rising, investors said, I don't know what I own. I don't know what my legal rights are. I'm going to run for the hills, and I'll sift through the rubble later. We've done essentially nothing to fix that, to fix the fiduciary obligations to investors by trustees, to fix servicing standards in a meaningful way. And so I agree that the enterprises are too large a part of the market. I would argue a big part of the reason for that is we haven't gone back and fixed the plumbing on the private side, which has to happen before private capital can even come back in on that side of it.
Okay. Gene, did you want to,
Well, I guess the one thing I would say, I agreed a lot with what Jim said, and I think it does show, it's hard for me to understand totally Josh's concern of too much concentration. I mean, it's kind of hard to do better than 80% concentration. And when you have built-in duopoly advantages where the infrastructure is there and transition, you really have quite a huge barrier to entry ever. I don't know how it gets better. I guess I disagree that there's this huge divide in the kind of mission and safety and soundness. I think there's a bit of a myth that somehow there was like progressives or somebody pushing Fannie and Freddie to do huge amounts of subprime lending. In the late 90s, 2000, back when it was mostly a lot of the progressive groups doing it, those were also the people most focused on predatory lending. And there was not so much problems. Let's understand, this happened between 2005 and 2008, where Fannie and Freddie were not only acting like a hedge fund, but a terrible hedge fund, poorly timed, who decided to do 3 times the total amount of subprime in their whole life in those 3 years, the worst years there. Now that wasn't about complexity, that was just a complete breakdown of common sense regulation.
By 2000, they already had 80-to-1 leverage if you include on-balance sheet and off-balance sheet as a result of the portfolios. So the problem began long before that.
And by the way, we in the Clinton administration were warning on that, but on the subprime issues, there was no, the Fed did not find a problem there. And again, at that point, a lot of the people interest in low income were equally focused against predatory lending issues. So I'm just, maybe not, I'm responding maybe more to other things I'm hearing than what you, but the idea that somehow that what happened in 05, 08 was this conflict in kind of like mission is just doesn't bear the facts out. They became a very bad, poorly timed hedge fund with no regulator.
Okay, I'm going to keep going, and we're going to come back to Josh, so he's going to get a clear shot here. So don't worry. And we're here both for light, but we can have some heat. It's fine, light. So, Drew, you want to?
Yeah, I would just make one point. I mean, I'd echo Josh's point in that, if we're looking at the concentration in the market, it feels a little bit like we're moving sort of to Chapter 2 without looking at Chapter 1, which clearly appears to be the plumbing of the system and rep and warranty, and the fact that how risky it is, and just all one needs to look at. Obviously, there's some other reasons for it, but if you look at B of A Countrywide's sort of devolution in the market, so to speak, and as you've watched, Wells and some others sort of take up the reins. So clearly, in what should be a relatively, profitable business and pretty synergistic for them, I think there's still a lot of challenges in that piece of the business.
Yeah, Don, can you?
I want to come back to Jim's comment about multifamily, which tends to get lost in the shuffle because it's smaller, that it worked. Why did it work? This is me looking in retrospect. Skin in the game. Fannie and Freddie have different business models in multifamily, but in both of them, the one common aspect is the originating banks had skin in the game, or somebody was underwriting who had skin in the game in the long run. The single-family system doesn't have that. It's technically the mortgages get sold to us, and they are off the hook, ignoring some legal liabilities, which will come back to haunt them a lot. Who had skin in the game? So I just want to highlight that point in Jim's comments. Major issue that hopefully will be in the design of a future state.
Okay, no, good. And I think everyone understands that we could do a full day up here, and obviously we're touching on the surface. I want to keep going so we get to hear from everyone at some length here. Don, let me go next to you and again. I know you can't talk about policy matters because the company is in conservatorship. But let me ask you about the company itself, which obviously is changing, right? I mean, you've been CEO since 2012, and as I said before, it's a remarkable public service, right? I think you, Tim Mayopoulos at Fannie, and others have done this, and the late Herb Allison, I'd say exactly the same thing about him, the public service that you and the others have done. Right, you went in knowing the political environment you're going into. Can you tell, what have you learned, and especially what has surprised you? And then let me ask you, combine a second question. And so, of course, even in conservatorship, the business is changing.
Right.
And what kinds of changes you have going on?
We go to the slide, and I'll try to do this real quickly in the interest of time. Slide change. There we go. Next one.
Yours are before.
I think it was yours at the beginning. I think yours was
maybe one. Yeah. Try the first one.
And flip back here.
No.
Flip back, please.
Nope. It was just keep going.
Flip back. Nope.
That's it.
Very good.
Okay. So what was a surprise to me, or what do people not commonly understand? And Gene's made a lot of reference to things I'm not sure everyone understands. Number one, the business model of the GSEs is not to put a guarantee on top of some mortgages. It's to buy those mortgages in, take control, and then issue these mortgage-backed securities that have always been considered by the investors to have no credit risk, to be sovereign, near sovereign. Therefore, they just worry about prepayment speeds and interest rates and such. This is true now because we have an official agreement to support us. It's true in most of the future state proposals because they're talking about full faith and credit guarantee. What is not understood is before conservatorship, it was what was called a wink and nod system, an implicit guarantee. It was not like banks get FDIC support. It was not general support. Very targeted, so we could issue $5 trillion of securities, which is an immense amount, that traded as if it had no credit risk because it was sort of like a government security. That allows us to have the 30-year fixed rate free prepayment option. That allows us to put $5 trillion out in the market because it's hard to find investors for $5 trillion who will take real credit risk. People don't realize that. They didn't think about it. The companies didn't advertise that back in the old days, but it's absolutely true. Always a creature of government. Number two, the industry was built upon the assumption of the post-World War II experience of near zero defaults. Just fell apart when the crisis happened. Lawsuits between all the players, servicing departments were these tiny little operations to move a little money around, and then now there are 10,000 people who have to handle things. There were a lot of accusations about the banks as servicers mishandling consumers. Yes, they just fell apart. Foreclosures, it was run them to, if someone was delinquent, run them to foreclosure. Now you have modification programs, HAMP and HARP. None of it existed. Third thing is our earnings. Even before conservatorship, what was called the hedge fund, taking unsecured borrowings that the government inadvertently supported, so they were really cheap, and buying assets, not the mortgage guarantees, buying assets was the largest source of earnings in both these companies, not the actual core business that they were set up to do. That's point number one. Point number two, recently we've had tremendous earnings, and everyone's talking about the federal government becoming dependent upon it. Well, I hope they're not depending too much, because if there were equity analysts honest, they would quickly go through them and find out this is a one-timer, that's a one-timer, this is recovering losses previously taken. Well, if the cycle does better, we'll get a little more, but not too much. If you do all that, our core earnings are a mere fraction of what has been recently reported. Just take the calculator, the pencil, and the daunting 10K of 300 pages, and you can figure this out. Fourth point is, how large is the business? Single-family mortgage assets are 10 trillion. Washington, trillions get thrown around pretty easily. I want to compare it. The entire domestic banking system, United States, only has $13 to $15 trillion of assets. Mortgages is almost as big as the entire domestic banking system. And half of it, 5 trillion, runs through two companies, undiversified risk in two companies. Not a good structural system for the long run. And the last part I already mentioned, this business is extraordinarily complicated. It's so big, it's been sliced and diced. You got originators, aggregators, servicers, you got sub-servicers, you got all the complex options trading from the free prepayment in the markets. It's not clear anybody understands the entire system, and every time policymakers start to say, let's do X at a level, then you get down to the mud of the details and the dirt under the fingernails, it gets really, really hard. Next slide. So that's the key insights to understand. While we're in conservatorship, I've been basically told about the first 2 years of conservatorship were pretty stable, just babysit. And then the FHFA took leadership to have change, to lead the industry, which is pretty backwards in a lot of ways, to be better. I'll focus on private capitalist first loss. When I started talking to the government about taking this job, it was assumed that private capitalist first loss required legislation, and that would be part of a future state. And they discovered, well, maybe we could actually do it while we're still in conservatorship. And off in the corner, our multifamily business, not Fannie's, ours, does almost all their business what they call K deals, just an acronym that developed over the years. In a K deal, we sell a subordinate piece of a loan pool out to private investors, and well over 95% of the risk goes to private investors on over 90% of our flow. The future state, it's like the old TV commercials, the future is now. We're already doing this. The private capital first loss, substantively the entire business in our multifamily exists today, other than certain affordable stuff. So it is possible. Single family is harder. We had a skunk works that worked for years on details, how to do some kind of laying off of private capital first loss. And the first deal got done last year. We have our acronym STACKR. Fannie followed with theirs, which is called CAS. It's a partial layoff, some risk. What everyone here should understand is this is probably going to be a stair step of 5 to 7 years of developing tools that will evolve to put more and more risk more thoroughly out into the private sector while we're in conservatorship. If there's no legislation for the next 2-3 years, we'll be substantively, my prediction, there, i.e. the vast majority of risk will be going to the private sector through us. That will reduce taxpayer exposure while we're in conservatorship, which everyone thinks is a good thing.
Okay. Okay.
Second,
sorry, please.
I'll stick.
Okay.
The time, want to skip the rest or keep going?
No, take just 2
seconds.
No, there's 2 seconds, yeah.
The plumbing. People talk about the plumbing.
Yes.
It's a backward industry. The FHFA using Fannie and Freddie have done a lot of things to make the plumbing better, servicing standards, data standards, trying to get a little more up to date. And the famous CSP, the Common Securitization Platform, which is kind of half built at this point, which can be good for us in the meantime and good for possibly the future state. And let me skip mortgage insurance.
Okay. Okay. Very good. All right. I'm mindful of the time. I want to make sure that I get Drew and Josh in the field of fire here. So I was gonna ask Drew about private capital. Right. So I'm going to go straight to him, and then we're going to go up and down again and get Josh some questions. So Drew, bringing private capital back into the system is, I mean, that's really the center of reform. And you've got the market's perspective. Talk about the prospects for that, and both the prospects and the obstacles, and what does it mean for housing, and what does it mean for American families?
Well, by way of background, I come from Citi, obviously, and work in distressed debt on the distressed debt desk, and look over all the research. And so our perspective on this is, we've traded, I actually had the numbers run on Friday, in the last 12 months, we've traded a little over 10 billion of the GSE preferreds. So, full disclosure, that's sort of my background of where we're coming from. By way of background, that's 33 billion in total on the GSE preferreds between them. So I think we have as good a sort of bird's eye view of the existing capital as anybody. I think what's happened in Washington to this point is heroic. I mean, given nothing has happened, and you see the White House lining up with the Senate Republicans and Democrats to push this far is incredible. I think what we continue to hear over and over from our clients, who are the largest, most sophisticated hedge funds in the world, is concern about how the existing capital is going to play out. And I know this is a sort of third rail subject for a lot of people, but I think it is something that's important to bring up, just in the sense that obviously as Johnson Crapo goes forward and the evolution of Johnson Crapo goes forward, or whatever comes out of that, the 10% first loss position capital is going to be key. It's the vital question. It's the top of anybody's list on how this is going to play out, or whether it's 5% or whatever the number ends up being. And I think as you look at the process from the outset, that first loss capital is going to come from a lot of people, let's call it real money funds, whether they're in Boston or the West Coast or wherever, that aren't necessarily impacted or have any axe either way on how existing capital is treated. I would caution, however, that when we move forward in what's inevitably a very cyclical industry, and maybe not in the next year or two, but 5, 7, 10 years out, and depending on what the regulator does as far as waiving 5, 10% capital requirements, more expensive capital is needed to keep the wheels greased in the system, and you are looking to higher cost of capital providers. You're going to be looking to a lot of those people who may not have liked the way things transpired. So as we sit here today, obviously Washington, I think there's a very positive step forward in the bill this morning as far as speaking to the litigation. Is Washington's taken a pretty firm view that we're going to push this to the courts, let the courts figure it out, and we're going to focus on the nuts and bolts of the bill. And the only thing I would say about that is that that's one respectable view. But I would caution that, is it Washington's also view as far as we're looking at a bill, as we're looking at the middle class, and at the end of the day, mortgage rates, the underlying G fees, which are going to drive mortgage rates, to sort of potentially take the lead here and say, capital markets are at the center of our economy. Capital markets are at the center of our, incredible growth over the last 30, 40, 50 years. And is that something we really want to mess with? And, in the United States, historically, we've had a dissolution of any entity. We either put it through a Chapter 11, Chapter 7 receivership. Here, obviously, this is, pretty uncharted territory, and conservatorships are something that's obviously been used in banks, but through a rehabilitation. So, my only comment coming from the markets is what our clients are telling us, and which is probably the next layer of capital further along in the cycle, which is just be cautious about what that may mean for risk-free returns going forward and what that may mean for mortgage costs. Okay, no, very good. All right, let me go, Gene, do you want to respond? No, okay, I'll get you next time. Josh, no, okay. Do you guys want to, I was going to.
Well,
okay.
I mean, from a capital standpoint, I agree that there's a lot of capital missing in the mortgage system today.
Yep.
I mean, even Fannie and Freddie at zero have a deferred tax asset that's, wouldn't by a bank regulator be treated as capital. Mm-hmm. So there's many hundreds of billions of dollars of capital that's going to be raised in the system to support the mortgage market, and that's something that Johnson Crapo hasn't really faced up entirely as to how that capital will be raised in whatever form.
Okay. Good. Okay. Let me ask Drew one quick question then, and then go ask of Josh. And there's a lot of discussion about the legislation about the role of big banks in the future system. And as I understand it, Citi is a pretty big bank, a pretty big institution. But of course, origination today is dominated by two different firms, right? Wells and Chase. Securitization is dominated by Fannie and Freddie. So is there room for entry? What would you see the role of the large financial institutions in the future system?
Well, I think Johnson Crapo has been very thoughtful about this, and obviously I think we're seeing the aggregator being split from the guarantor, which I think is important. But you obviously still have the originator and the aggregator role still in the bill together, and that obviously causes some concern for people. I don't have a Citi view on this. I think my personal view, as someone who does try to follow this relatively closely, is that we have come from a place where that has been an issue in the past, obviously, and previous iterations, the large banks did get some preferential treatment on funding. But I would say the analogy isn't dissimilar to retail in a sense on originations that, if you look at the top 10 originators in the country, you have the Quickens, the Nation Stars, et cetera, in addition to sort of that's dovetailing into the servicing commitments they're taking on. But, there's a real democratization potentially of origination, and I'm not sure how much of a leg up, so to speak, the large banks will have. I mean, Wells has clearly made a huge push. I think they're combined, the next three guys are the size of Wells at this point on overall originations. And that's all a natural outgrowth of any crisis. I mean, when you have someone of B of A, I think as I said before, B of A countrywide size sort of stepping back. So, I'll let, I think Josh has some views on this, I'm sure all you do, but I think that in the new bill, I think there is a role for, a wide range of originators.
Okay. Do you guys want any comment on big banks? No, yeah, please, Gene.
No, I just think, I've been out for 5-6 weeks, but I do think one of the issues that's been raised is going to be the vertical integration issue and the concern of some of having major originators also be guarantors. And so I think that is, and I think that there is enough, I don't know that concern necessarily just fits in one party. So I do think that is an issue that, I think there's a chance that there will be some, could be some movement on that concern. And I think for this bill to go through, there's been a lot of things to also make sure that people feel community banks, in addition to having a common platform, that there's a mutual that they can be part of. And I also think, the concern that somehow if the big originators were also guarantors, that would kind of push people out is one of the things that I think will be, you may see being debated at the committee level, but certainly as it goes forward.
Okay. Yeah, no, so I've testified at Senate Banking a couple of times, and what's remarkable is it's not that everyone thinks the same, but there's a certain element of the committee is trying to figure things out. And so you see Senators Vitter and Brown, right, from different sides of the political spectrum have legislation together and agree, and there's lots of it's an interesting committee.
Well, since you brought that up, I mean, it's interesting, it's important. In Dodd-Frank, we recognized both sides of the aisle and both parties that we had a problem with concentration with too big to fail banks. Mm-hmm. And yet this bill ultimately increases the too big to fail aspect in many ways. And I think when you talk about the GSEs as the large securitizers, I think that ignores sort of the greater issue, which is they were intended to be secondary market players. And part of the problem is they crept into the primary market. They competed with the primary market, accelerating their pro-cyclicality. And now we're talking about the commingling of primary and secondary again by handing the secondary market functionally to the primary market players. And I think we need to really think about that.
Okay, so this is what, okay, very good. This is a good lead. So this is my next question then is for Josh. And I would encourage everyone to read his op-ed as recently, right, I printed it out. It's March 27th of this year in the Wall Street Journal. And then of course, like I said, his book with Gretchen Morgenstern and other writings. And you've been a very strong and clear opponent of the Johnson-Crapo bill.
And the GSEs historically.
And the GSEs, so it's interesting. So it's not, not saying everything's right, but saying we got to get the solution right. Why don't you set out your view of the bill and just take, don't take too long because I want to give everyone a chance to fire back. And then I want to ask you, maybe I'll ask you two questions now and you can address both. What's wrong and how would you fix it? What would you do instead?
So I think you have to start with what went wrong, is it fixable? Does the bill fix it? And to me, the answer is no. Now, there are several key issues. First of all, the first loss position that we keep hearing discussed, I think is not real. And I'll read you a couple of points from the bill itself. Section 302 says that the FMIC can approve credit risk sharing mechanisms, quote, that do not represent the first loss position with respect to single-family covered securities. So it can be phantom if the regulator so deems it. Section 302(4)(b) also supports diminution of first loss, quote, nothing in this paragraph shall be construed to limit an approved guarantor from engaging in other forms of risk sharing or risk mitigation using mechanisms that have not been considered or approved by the corporation. And then in bad times, that first loss can be waived. Now, I think it's important to remember that the regulator is going to have to keep up with the innovation of Wall Street and the sophistication of innovation by Wall Street. Now, roll back the clock 10 years. Major bank says to the Fed, don't worry about all of our risk. we've laid off most of it through CDS to the largest, strongest insurer in the world. How did that work? How well did that work for us? Does anyone remember the AIG bailout? Second of all, it ignores that there really isn't enough private capital. So if you think about it, you've got a $5 trillion market, 10% first loss, $500 billion. The entire asset management industry, real money players and hedge funds, is $14 billion. Is that really where we should be directing capital? And, by the way, to demonstrate how hard it is to raise that first loss, the private mortgage insurers today only have $7.9 billion. They've raised $2 billion of that since 2011. So the amount of first loss that you're talking about, even though it's phantom, is problematic. And Wall Street will increase the procyclicality of that because at the time that the markets start getting weaker, investors will pull back to force the regulator to waive that first loss position, accelerating the procyclicality. Moving beyond that, I think it's important to look at some of the ways that they're trying to bring that first loss in. So under the bill, the first loss securities are exempt from the 33 Act. In other words, they don't have to be registered. They can be sold without proper levels of disclosure. Now, if anyone remembers, that was the same with the CDOs that brought us to crisis. If that's the type of lack of transparency that we're building into this to be gamed, we're essentially saying the private first loss, if we're going to get it, is got to come from stupid money, because smart money is going to price it much higher. More than that, it increases the full faith of the U.S. government. Quote, the full faith and credit of the U.S. is pledged to the payment of all amounts from the Mortgage Insurance Fund, which may be required to be paid under any insurance provided under this title, which means if those first loss mechanisms are incorrectly priced or wrongly approved, taxpayers are back on the hook.
So now shift, now go. So how would you fix it? What would you do?
So look, Fannie and Freddie failed, to oversimplify, but for a few reasons. In fact, I was probably the first short recommendation on Fannie and Freddie in 01. Fannie was at 86, it never touched that again, and warned that this is exactly where we were going to go after home prices would appreciate, which I warned was going to happen. Fannie failed because they had inadequate levels of capital, because they were allowed to use their portfolios for other than liquidity purposes, because they priced their G fees less on the credit risk, but over time, based on volume of the originator that was giving them production. So to me, real capital, portfolios for liquidity purposes only, you have to price the credit risk appropriately, and you can use market mechanisms for that pricing. And most importantly, they're secondary market utilities. That's what their intent was. Regulate them as a utility. We hate the word GSE, but we forget our electric, our gas, our water utilities are utilities. Regulate them with an allowable rate of return. Anything above that allowable rate of return gets plowed back into capital. The only question that complicates my solution is, does the actual guarantee exist within the enterprises or outside? I think that's something that can be open for debate. And certainly, the guarantee should be on the securities rather than on the companies.
Okay, no, very good. And I should just mention Representative Delaney, who's from Maryland, my home state, has his own proposal which features a really interesting mechanism to price the government guarantee. So I know he's interested in that. I'd encourage you to look at Representative Delaney's proposal with Himes and others, and Carney from Delaware. Well, I gotta let the others comment. Okay, I got to let the others comment. I'm sorry, Manny. Let me, I'm aware of the time. We have a clock up here. I have a little less than 6 minutes. So I want to give Gene the last word. I want to structure it to go this way. So I'm sorry for putting pressure on everyone else. But why don't we go down and
well, as you
comments.
As you indicated, because we're in conservatorship, I have to stay with policy matters. I'll just emphasize that the GSEs now are operating pretty well. So in the short run, things are working fine. I will, however, confirm, as many have said, in the long run, it's not good to keep the companies in conservatorship. It's financial issues, people issues, you never know what's going to happen. It's a long-run unstable situation, even if it is. So we're all in favor of final legislative bills being put up. and we wish it well. We just do recognize the difficulty of getting all the details right.
Okay, great. And thank you again for taking it on.
Yeah.
Well, I agree with Don that things are working okay in the conservatorship. I think Ed DeMarco, who's, I guess, leaving this week, has done a very good job of leading the agency and being the conservator. The real issue to me is where we go from here, and recreating what we had is not going to work, which some people seem to think is the right answer. And so I think we need to build upon the Johnson-Crapo, put in some better elements to that at longer term. And my solution would be that we will need a catastrophic government reinsurer, but it should be much smaller than the marketplace today, maybe only 30%, as I said before. And really, the key thing, again, is countercyclicality. If we don't build in countercyclicality into this structure, we might as well not do anything.
I mean, just the point I'd make would be maybe to reiterate a little bit of what Josh said, but when I look at the fix to the problem, I just wonder if the basis of the fix isn't, obviously, what we had obviously didn't work. No capital, retained books, et cetera, massed hedge funds. That doesn't work. But what did work for a long time before that was a guarantee book that ran with a fair amount of discipline. And if you want to regulate that as a utility, you go the step further. You have no retained book. Obviously, you're doing stackers and cast deals, which are small at this point, but over time will get bigger and bigger and provide another layer of protection. And lastly, let the entities build real capital. I mean, you're talking 4, 5, 6% capital ratios. That doesn't seem unrealistic, particularly that's what the banks hold. And if you're regulated like utility and you have the extra layer of the stacker cast deals, it doesn't seem like a bad place to be.
Okay, good. Gene?
The funny thing was when Josh was actually kind of giving what he thought was wrong and fixed, I didn't feel that we were in a much different place. I have a more, I think he has too negative a reading of what's in Crapo-Johnson to me. I mean, the capital of whether it's first loss or a guarantor holding a certain amount is, even almost all the amounts we're talking about would have been enough almost for the crisis. And then no one's mentioned that they then have to pay an actuarial fee into the MIF fund, which would go up to be 2.5%. So you have a total backup. So your protection for taxpayers is just dramatically better under the situation. Now, you don't want to go too far that you actually do more than is needed and have too much a negative effect on prices. And then I think that some of the things where you're looking and trying to say this is a concern is actually people trying to build in the counter-cyclicality that Jim is talking about. Now, maybe you could have that be more automatic, but I do think it is important that we have those tools. And as somebody who lived in 2009 through seeing the government constrained, where like your options were limited by whether you could get more TARP money or not TARP money. I don't think that's a great thing for our country. Having lived through, I think the people have to have a certain counter-cyclical flexibility when you're in the middle of that. I'd just say finally, I don't have ideology over the mechanism. I really don't. I don't think my goal is private capital or a utility. The goal is what do I think is going to be best for serving the American housing system. And to me, when I look, I think that having the remote government guarantee with the capital in front of it allows for innovation, it allows for protection. It asks what I think we should ask, what is the government role that's needed? And I think the remote guarantee puts the guarantee on the securities. I think you have to everybody else should have to lose their shirt. The protection should just be for securities because that's what we care about, is that we encourage that deep liquid market that allows future generation of Americans to have affordable home building. And I know that the founder of this conference, Michael Milken, has some dramatic differences, but under our current system, I think that should be the fundamental goal without ideology. And I think that Crapo-Johnson is in the right direction, and we should work with it and get it right.
Okay, so let me just say thank you to the panelists. I know we could go on, but obviously we have a time limit. There's a markup at the Senate Banking Committee tomorrow. I think all eyes will be there, and the conversation will continue. So thanks very much to our panelists and to everyone for coming.